Let's take our conversation forward, and we've got Ashi Anand from IME Capital joining in on the show right now. Ashi, hi, afternoon. You track some of these new age tech companies quite closely, right? Paytm, Policy Bazaar, etc. What do you make of the earnings that they've delivered so far?
Yeah, hi. Firstly, thanks for having me on the show. And I think in what has otherwise been a fairly bleak earnings season, new age digital platforms have clearly kind of stood out in terms of the earnings that they've delivered. Be it a Paytm, which has achieved profitability, I think, well ahead of what people were expecting. You've also seen kind of Blinkit and Instamart. You've seen kind of in quick commerce a space where investments were expected to be elevated. I think you have seen some level of peaking of quarterly losses, again ahead of market expectations. And you've seen the kind of move that Eternal has seen after the results. I think at the time when we had launched our digital disruption fund, we had been very clear around the aspect that markets and people were very clear about the longer term growth runway on these companies and the fact that they can grow at rates which are much stronger than others. However, what was possibly not as clear was the fact that the inherent business models are actually not just profitable, but highly profitable. Now, quarter after quarter, as these companies are continuing to outperform kind of street estimates in terms of profitability, a lot of people are now starting to kind of understand and factor in the fact that these companies can be quite profitable over the longer term. We have actually, and we had done this at the time when we had launched the fund, when at that point in time, most of these companies were still making hundreds of crores of quarterly EBITDA losses. We had kind of projected out profitability and margins over the longer term, and we have earnings models that go into 30 and 32. What happens is actually very, very interesting. As these companies achieve a certain level of maturity, they continue to be able to grow without having to invest as much in customer acquisition and getting customers to transact more, etc., because customers get that much more embedded onto their platforms. A very large part of their cost structures are actually linked to this hyper growth phase. Some of these costs can actually come down on an absolute basis as you no longer have to spend as much to acquire or incentivize customers to actually transact. A fixed cost base, which is largely stagnant and increasing revenues, leads to a lot of room for both operating and financial leverage to play out. And at least what our models show very clearly is that the longer term profitability of these companies are very, very attractive, and they also generate very strong free cash flows. The combination of the sheer scale that is coming driven by the hyper growth and kind of very healthy profitability is a very, very strong recipe for kind of value creation. And I think that is why it's not just over the shorter term, but we have repeatedly on this channel and others been indicating that we believe this is going to be the decade for digital platforms. And at least the results that we're seeing so far are quite kind of encouraging for that trend.
Indeed, that's about the take coming in on some of these new platform companies. But along with that, one of the other stocks that is since the start of the day has been holding itself, being one of the top gainers on the Nifty 50, and that's Tata Motors. Because this time around, in terms of earnings, though we have seen a mixed bag, the profits was higher versus the estimates, while the revenue was in line. But there was a slight miss on the margins versus the estimate of 10% on the consolidated front. But despite this fact, the stock is up around 3%, and all thanks to the JLR EBIT margin guidance that has been maintained to 5 to 7% for the full year versus 4% what the company has reported. The double-digit margin in the commercial vehicle continues, though for the passenger vehicle, the numbers were not that great, but the commentary stands tall. But in terms of the brokerages, it was DAM Capital that has gone ahead and upgraded the rating on Tata Motors to a buy now and marginally raised the target price too from 750 rupees earlier to 775 rupees. They're saying that any demand recovery would be the key trigger for margins and valuation expansion. They've largely maintained their estimates, the valuation and the fair value for each of the businesses. But this target price hike, 25 rupees, that's on account of translation effect of JLR financials into INR reporting. And because of that, we have seen great moves on Tata Motors, still holding strong. 3% uptick is what we have seen. But Ashi, we just wanted to have your take on Tata Motors. The business and the JLR division has gone through a lot of late, be it the kind of uncertainty due to tariff, the demand slump in some of their key geographies, and given the fact that the valuations, they have corrected sharply and the stock is almost half from its all-time high. Do you believe it's a good bet and an attractive bet to enter once again into Tata Motors?
Motors is clearly interesting, right? And I think there's one part of the call which is relatively quite easy to take. The domestic business is doing reasonably well. On passenger vehicles, I think over the last 3 to 4 years, you've seen a great kind of launches by Tata Motors. They've been able to kind of gain market share. And even in terms of the positioning, in terms of electric vehicles, and which is where the kind of future is moving towards, I think the domestic passenger vehicle business seems very well placed. On CE, that is a duopoly between them and Ashok Leland. I think they managed to capture lost ground there. So the domestic part of the business is, I think, the easier call to take, and that clearly does have a certain amount of value. What is actually quite challenging in this, you've seen a lot of fluctuations in margins on the balance sheet health, demand across trends, etc., is what really is happening on JLR. Now, JLR is really they are a couple of very strong brands. But if you just understand what's happening from a global tariff, and that does impact the North American market, which is quite important. The other element is really China and Chinese demand. BYD has become a very important threat over the recent years. Now, this does impact JLR's positioning in kind of China, but you also now have to contend with another emerging competitor in your other developed markets. I think from a longer term perspective, JLR's competitive positioning vis-a-vis the BMWs, the Mercedes, both of them are actually further ahead on electrification than a JLR is. And there are kind of investments that need to be made to catch up on those investments. So I think what happens is getting an accurate valuation on JLR is that much more challenging. And that is really what's causing these fairly large fluctuations in the share price. Given the fact that the share price has fallen quite significantly, it may seem actually quite attractive. The key call is how are tariffs going to emerge and what happens to kind of global demand, because that's going to be very dependent, very important for kind of the stock price going forward.
Ashi, you're saying avoid Tata Motors till you have clarity on tariffs?
So relative tariffs, right? As in for Tata Motors, what's going to be important is going to be the US's tariff on the UK. And also what would impact is kind of versus other like US China tariffs, etc. You need to understand the relative tariffs globally as compared to the US India tariff, which is what's important for most other companies in India. I think once you have clarity on that, and you also need clarity on global demand. I think once you have clarity on both of those, the recent quarter earnings were clearly encouraging in terms of profitability. So if as some of that kind of emerges, it becomes a much easier bet to take. But I think given the fact that it's fallen quite significantly off the highs, buying even today may not be that bad an idea.
Okay, but Ashi, barring Apollo Hospitals, the last two Nifty companies will also be coming out with their numbers tomorrow, and that's Hindalco and ONGC. Both on the commodities front, both have their own set of global factors at play. Where do you peg these numbers could be in terms of just a rough sense on how the quarter gone by could look like for both of them?
So without going specifically into kind of quarterly estimates, let me just give you the broader outlook in terms of the commodity space. This is a space which is aren't very active on because we kind of prefer buying companies with kind of secular growth potential, which have the ability to grow year on year. Commodities driven by kind of a global commodity cycle. You miss this kind of longer term compounding. You have to get your time of entry and exit kind of quite right, timed in line and being contra to what's happening on the global commodity cycle. I think a core element before one gets bullish on kind of any of global commodity, it is important to understand that you are in this kind of unprecedented environment of increased kind of tariffs by the world's largest economy. And this is likely to have some kind of a repercussion on a global slowdown. Now, in an environment where you're kind of having kind of demand potentially coming off across some of the major global economies, it becomes a bit difficult to actually take a strong favorable call on any major global kind of commodity. The other important element here being for the past couple of decades, China has been a major delta growth driver in terms of demand for global, for be it metals, be it oil and gas, across all kinds of commodities, with the Chinese economy kind of not in the healthiest zone. Demand is something which I don't think we're seeing a lot of robustness on, and accordingly, by and large, it's a space we're not very active on.
Okay. So, Ashi, I wanted to ask, since we're at the fag end of the earnings now, anywhere based on earnings where you've added positions or reduced, any tactical changes that you may have made or even long term for that matter?
So we were kind of quite hoping to be able to use the earnings season to identify areas where growth is kind of coming back. Unfortunately, that is not something which is very visible. By and large, across most sectors, you are seeing kind of growth being quite muted. Now, in the context of this kind of overall global uncertainty around what's happening with tariffs, and I think more importantly, a relatively weak earnings season that we've gone through, we have actually tactically increased our cash holdings a bit. We believe if there is some amount of volatility, we do want to have the ability to actually take advantage of that to be able to buy and build certain positions that we are looking at. But I think the major change that we've really made over the coming result season has been actually generation of small amounts of cash to be able to take advantage of any tactical opportunities. But just by and large, I think results have been quite muted, and we're not yet very clear which sector is going to drive the kind of growth recovery going forward.
Seems like we need some more time, some more visibility to understand the clear winners and losers, as expectations have been muted and so have been the overall earnings. Not all that great, but not all that bad either.